I want to talk about trading options for high returns with low risk. And we're going to look at trading option spreads versus directional trades. And whenever we have a profit in a directional trade, whether it's a stock or an option, we always protect that profit by using options so that we can protect the profit. In some cases, we can actually guarantee a profit for the trade, and I'll show you some examples of that. So whenever we have a profit in an option, we always protect it by creating a spread trade. And let's look at the risks of trading options. In general, when you buy a call option, the underlying stock must increase in price above the strike price of the option at expiration, or you'll incur 100% loss of the option premium. So let's look at an example. This is a option chain for Facebook. Facebook stock was trading at 132.07 at the time. So let's say we were going to buy the 135 strike call. We can see that was trading at 310 bid, 315 ask. So if we went ahead and bought that option, Facebook stock would have to close above 135, or you would incur a total loss of the $315 premium. So that you're always facing a 100% loss whenever you buy an option. So we always keep that in the back of our minds, and we're always looking to create a spread trade whenever we have a profit in a call option trade. This is a snapshot daily price movement of the VIX, the volatility index or the fear index. And over the last couple of years, the market's been fairly choppy. Back in 2012, 2013, and 2014, the market trended pretty well, and it was a lot easier to make money with options. But the last couple of years, it's been choppy. There hasn't been a straight trend up the last couple of years, and each one of these spikes in the VIX index, of course, represents a sell-off in the stock market. So if you had bought a call option and you had bad timing during any one of these sell-offs that you see here, then you could have been stopped out of your trade. So we're going to show you how we reduce that risk of entering an option trade, and with the goal of preventing yourself from being stopped out of the trade. And unlike directional trades, option spreads can profit if the underlying stock increases, decreases, or is flat. So if you in a directional trade, of course, the underlying stock has to go up, and it has to close above that strike price at option expiration, or you're going to lose 100% of your premium. But option spreads can profit if the underlying stock is up, down, or flat. And we're going to look at a little known option spread strategy that we use that can literally eliminate the risk of your trade and guarantee a profit. And I'll show you actual examples of that. So let's talk about our directional trades first and how we select trades. And we use what we call prime trade select to select an option directional trade. And there's 3 steps in prime trade select. And there's a Metastock module available for prime trade select that will comb a database and then come up with trades that qualify under prime trade select. And once we enter a directional trade, then we have 3 simple rules to manage that directional trade. We always exit losing trades quickly before they turn into large losses. We don't exit a winning trade with a small gain, and then we use options to protect profits. If we get a profit in the trade, then we'll use options to protect those profits. So once we enter a directional trade, We'll exit quickly, and I'll show you some examples of that. We'll exit quickly before it turns into a large loss, and we won't exit a winning trade with a small gain, and I'll show you how you can do that and at the same time protect your existing profit. And we're going to show brokerage account statements that show 1.9 million in actual closed trade profits using Prime Trade Select and the option spread strategies we'll talk about today. And we also have a snapshot of open trades, and that shows 1.2 million in open trade profits using Prime Trade Select. So as a little bit about our background at Optioneering, we have over 60 years of combined trading experience. We started teaching option strategies to other traders 21 years ago. Prior to that, I just traded on my own, and about 21 years ago, I started teaching my option strategies. I started out trading options with a $4,600 trading account, and then in my first 2 years, I had over $460,000 in profits, which is more than I made the previous 6 years as an airline pilot. So these are just my tax returns those first 2 years that I was trading options, and these show those first 2 years I had $460,000 in profits. And the Optioneering team, we've received a total of 13 of the World Trading Championship trophies, including 8 first place, 4 second place, and 1 third place trophy. And I won the World Trading Contest 8 times, which is more than any other trader. And that's a real money contest, and the results are audited before they're posted on the sponsor's website. So these are real-time returns. I took first place with a 309% real-time return recently, and the year before that I had a second place with 339% real-time return. So we're just showing these profit results so you can see that the strategies really do work. Okay, let's talk about Prime Trade Select. And step 1 in Prime Trade Select, and we're talking about now when we select our process for selecting directional trades. And the first step is to determine the price trend of a stock using the 50 and 100-day exponential moving average system. And then step 2 is we select a low-risk entry point using the Keltner channels, and I'll show you some examples of that. And step 3 is we use what we call the 1% rule to select the option strike price with a high probability of success. So these 3 trade management rules, of course, the 1% rule is just as important as selecting the option itself, because you have thousands of strike prices to choose from in a lot of those liquid stocks. So the 1% rule is just as important as the actual trade selection, because it allows you to select a strike price with a high probability of success. And we'll show you some examples of that. So for step 1, we determine the price trend. We use an EMA trend following system to determine the price trend. And the goal of the EMA system is to quantitatively measure the buying and selling pressure of a stock, and it allows us to follow the trend instead of trying to predict the trend. And we like to use trend following, a trend following system instead of making emotional decisions. And we've been using trend following successfully for more than 30 years. The trend following worked well in the 2002 and 2008 bear markets when we had short positions. So in my personal account and in my advisory services, we were heavily short during the last 2 bear markets, and we were able to do well. So it's a very simple trend following system. If the 50-day exponential moving average is above the 100-day, then that stock is on a buy signal. And if the 50-day exponential moving average is below the 100-day EMA, then that stock is on a sell signal. And if a stock is on a buy signal, we'll purchase the stock or a call option. And if the stock is on a sell signal, we'll purchase ETFs or put options on the stock. And as I mentioned, the trend following works in both bull and bear markets. Right now we have bullish positions, but we're always looking for a trend change and to switch into bearish positions if we start to enter a bear market. So let's look at an example of a buy signal with the EMA system, and this is a daily price chart for Cigna, the insurance company, and these red and green vertical lines, this is the daily price movement of Cigna stock, and the blue line right here is the 50-day exponential moving average, and the red line is the 100-day exponential moving average. So we can see right back here, the blue line actually crossed above the red line. So at that point, Cigna stock was on a buy signal, and as long as the blue line stays above the red line, which is the 100-day, then that stock remains on a buy signal. Here's an example of a sell signal. This is for the China ETF, and we can see this is the daily price movement of the ETF right here. And the blue line, again, is the 50-day EMA. We can see right here it crossed below the red line, the 100-day EMA. So at that point, the China ETF was on a sell signal. And again, as long as that blue line remains below the red line, then that stock or ETF is on a sell signal. Okay, so first we determine the price trend. And if the stock is on a buy signal, we're going to buy a call option. And what we like to do is select a low-risk entry point, and we use the Keltner channels to select our entry point. They're similar to the Bollinger Bands. I found for our purposes that the Keltner channels are a little more accurate, so we prefer using the Keltner channels. And here's an example of the Keltner channels. They're an overbought, oversold indicator. This is daily price movement for Home Depot stock, the red and black vertical lines here. And then there's three Keltner channels. There's the upper channel right here, and the middle channel is this dotted line right here. And then, of course, we have the lower channel. And the channels act as an overbought, oversold indicator. And you can see when the stock is trading near the upper channel, then it's getting overbought. When it's trading near the lower channel, it's getting oversold. So we like to use these channels to time our entry. And here's an example of this again is the daily price movement of Home Depot stock. So what I did is I circled the price movement when it got up or above that upper channel. I circled that. So obviously you don't want to buy when it's trading up near that upper channel or above the upper channel. You want to wait for a retracement to the middle channel, which is the dotted line, or the lower channel. So we will wait and time our entry, and you can see Home Depot stock here got overbought because it was near the upper channel, and of course once it gets overbought, then the odds are it's going to retrace. So we can see overbought, retraced, then it became oversold, and it rallied, got up near the upper channel again, overbought, it retraced towards the middle channel, overbought, retrace, overbought, retrace, overbought, retrace, overbought, retrace. So we'll wait for a pullback. We'll watch a stock and wait till it pulls back to this middle or lower channel. So let's look at an example, and in these examples, notice how the stock rallied after we purchased the call, producing a profitable trade. And so we use these Keltner channels to enter a trade. Here's an example for Amazon, and this is the daily price movement of Amazon right here. And what we're showing, this is our brokerage account transaction transaction history for an Amazon call option purchase we made. We bought 2 of the Amazon 330 strike calls at 113, and that was right in here. So you can see Amazon's been on a very strong price uptrend, and generally will retrace towards the middle channel and then resume the rally again. So we were following this, and then we waited until it got right in here in the when it retraced to the middle channel, and we bought the 330 strike call at 113, and then the stock rallied after our entry. So we got a good entry on that trade using the Keltner channels. Now, this option has since expired, but we roll over our expiring options if the stock is still on a buy signal. So we still own Amazon call options. It's rallied quite a bit since this initial position that we took in Amazon. So we use the Keltner channels to look for low risk entries. Here's another example. This is for Starbucks, and you can see when we took this snapshot that Starbucks was in a strong price uptrend, and when it got overbought, it normally retraced to the middle channel. So we were following this, and then right in here, we pulled the trigger when it retraced to the middle channel. We bought 14 of the Starbucks 40 strike calls at 13.75. So this is just another example of timing the entry, and then this trade worked out because the stock continued to rally after we purchased the call options. And when you do this, if you can get a low risk entry, then that helps you prevent being stopped out of the trade and results in higher accuracy trading. And once we decide that we're going to purchase a call option, we use what we call the 1% rule to select the option strike price. And once you decide you're going to buy a call option, we normally trade fairly liquid stocks or ETFs. So once we decide we're going to buy a call option on a stock or an ETF, there could be hundreds or even thousands of strike prices to choose from. So selecting the strike price is just as important as the trade selection itself. So option premiums consist of time value and intrinsic value, and options lose all of their time value at option expiration. So whenever you buy an option, you're buying a decaying asset. So you want to keep that in mind. And each day, an option is going to lose some time value, and then, of course, when you get to expiration, it loses all time value. So we keep that in mind, and due to these time decay characteristics of options, when you buy an option, you want to minimize that time value because that's going to decay to zero, and you want to maximize the intrinsic value. So what we do is we'll limit the time value portion of that option to less than 1% of the strike price. And if you do that, then you'll minimize the time value, which decays to zero, and you'll maximize the intrinsic value. So as an example, if you purchase an option on a stock that's trading at 100, you want to limit the time value portion of that option to 1 point or less. That would be 1% of a stock trading at 100. So if you're buying a call option on a stock trading at 100, you want to limit that time value portion of the option to 1 point or less, which would be 1% of the stock price. So if you limit that time value to 1% of the stock price, the stock only has to go up 1% in order for the trade to break even and for you to start making money. So this will have a much higher probability of success than a strike price that required the option or required the underlying stock to go up, let's say 6 or 10% in order to break even. So the stock only has to go up 1% and we start making money. So that obviously is going to be much higher probability of success than a strike price that requires the underlying stock to go up 6 or maybe 10% in price just to break even. And a lot of times the underlying stock, it won't make that expected price move. It has to go up 10% before option expiration, or you're going to lose 100% of your option premium. A lot of times it won't make that move, and you'll lose 100% of your option premium. So we use this 1% rule, and that deleverages options a little bit, and your percentage profit potential is less with an in-the-money call than it is for an at-the-money or out-of-the-money call, but it's a trade-off. You have a higher probability of a win on your option trade. So let's look at an actual example. Our transaction history shows that we bought the DVY, that's the dividend ETF. We bought the September 70 call at 1170. And at the time, DVY was trading at 81.38. So we bought the 70 strike call, the stock trading at 81. So that was an in-the-money call option. And let's look at the math on this and how you can calculate this time value portion of the option. So the stock was trading at 81.38. We bought the 70 strike call, and so the intrinsic value of this option, we paid $11.70 for the option. So the intrinsic value is calculated by simply subtracting the strike price from the stock price. So we hit this option that we paid $11.70 for had an intrinsic value of $11.38. And then you take the total premium, in this example, $11.70, you subtract the intrinsic value from that, and you can see that this option had a time value of 32 cents. And what that means is the DVY ETF only had to go up 32 cents, and this trade would break even and start making money. And we have a series of option calculators for all of our option strategies, and what these do is they calculate the profit potential for the option, assuming various price changes in the underlying stock at option expiration. In this example, from a 30% increase in the stock to a 5% decrease in the stock at option expiration. So these will calculate the profit potential with these various assumptions. So here's the analysis for the call option purchase. DVY ETF was trading at 81.38. We bought the 70 strike call at 11.70. So we can see that if the stock is flat at 81.38 at option expiration, we only lose 2.7% on the option. That's a lot better than losing 100%. So if we bought an at-the-money or out-of-the-money call and the stock didn't trade above the strike price at option expiration, then we would show 100% loss here at expiration. So, and we can see that if the DVY was up 10% at expiration, this trade would put profit 66% with a 10% move in the underlying stock. 20% move in the underlying stock would be 136% return. So even though we deleverage the option a little bit by selecting an in-the-money strike price, these are still good returns if the underlying stock goes up in price. These are good returns for this option trade. So again, with only 32 cents of time value in this example, the DBY ETF only has to increase 32 cents, and that's 0.4%, and then this trade breaks even and we start profiting on it. And again, when you use this 1% rule, that it'll be a much higher success rate than buying at the money or out of money calls that require a 10 to maybe even 15% move in the underlying stock just to break even. A lot of times that's not going to happen and you're going to lose 100% of your option premium. Okay, so once we select the directional option trade, then we have 3 trade management rules. We exit our losing trades quickly before they turn into large losses, and we don't exit winning trades with a small gain. And I'll show you how we don't have to exit our winning trades with a small gain because we'll create a spread. So, and then the third rule is we use options to protect any profits that we have on winning trades. So the trade management is just as important as the trade selection. You want to exit a losing trade quickly, and if the trade works out and you have a profit, then you want to use options to protect those profits. Here's a snapshot of some recent closed trades that we took. And this column right here lists the profit we had for the trade, the profit or loss that we had for the trade, and here's the second part of that snapshot. So this column right here, the column on the left, of course, has the stock, the strike price, what we opened the transaction at. In this case, we bought the LNG 40 strike call at 12.60. We closed it out at 24.10. We had a $6,882 profit on this. So what I did was I tallied up the losing trades in those closed out trades and compared them to the winning trades, and to demonstrate that you don't want to exit or you want to exit losing trades quickly before they turn into large losses. So in these examples, in these 2 snapshots here, our average losing trade was 14%. So we'll look to get out of an option trade. If we get up near a 20% loss, we'll exit. We were wrong, and we will simply exit before it develops into a large loss. And in this example, we exited, and the average loss was a 14% loss. So by not exiting winning trades with a small gain, we had an average winning trade in this example of 136%. So we had an average losing trade of 14%, and we had an average winning trade at 136%. So that's why you don't want to exit your winning trade with a small gain, because the winning trades can mitigate your losing trades. And for example, we only had to win on 1 out of every 8 trades in order for the portfolio to profit. So this is an example of why we don't exit with a small profit, because we want to hold on to the option and get a big winning trade. And if you do that, then you don't have to win on that many trades in order for your portfolio to profit. So we exit quickly with losing trades and hold on to winning trades. And of course, if you incur a 20% loss on your option trade, it takes a 25% return on the next trade to break even. If you incur a 50% loss, then your next trade you have to have a 100% win in order to break even. So how many 100% wins have you had lately? So we always exit losing trades quickly, 20% or less, and then hold on to the winning trades. And here's an example. This is this is a snapshot of open trade profits. We have two accounts. This is my larger retirement account, and this column lists the option that we bought, the quantity, the price we paid, the last price, and then our dollar profit and percent gain. So this is just an open trade snapshot. This retirement account had a $961,000 open trade profit using Prime Trade Select, and my smaller retirement account had a $247,000 open trade profit. So those trades were selected using Prime Trade Select.